Hey everyone, welcome back. Happy Tuesday. Hope you guys are having an awesome day. My name is Levi Woods. This is Drawbridge Finance, and we are here talking about options. As always, I don't offer financial advice. This is just my opinion. So full disclosure, no, this is only my opinion. Don't take what I'm doing as gospel. Don't do the trades without due diligence, but the type of trades that I make typically have a high probability of success, and I will show you any setup that you would like to do. So if you have a question about options trading, dividend investing, or anything that you want to talk about today investing wise, shoot a comment right in the YouTube chat. I can interact with you guys and I can do this live. So we're going to be here for the next hour or so, and we're going to take a look at IBKR's platform. We're also going to use Options AI. We're going to use Seeking Alpha, a couple of affiliate things that I use on a daily basis to try to assess my trades and look at where the potential profitability is going to be on the trades that I'm placing. So welcome, thank you for the likes, and let's get into this. Push this button right here. We're going to look at the screen. What we're looking at right now is IBKR. This is a paper trading account. And you can see over here on the right-hand side, I have this monitor. I have a few things set up. One of them, the first one that we always look at is the VIX. Now, the VIX is the volatility index for the S&P 500. It tells us what the approximate potential move is going to be over the next 365 days. So it's actually relatively low compared to the last couple of years. Right now, marking at 14.58%, a net change of down 0.43 or 2.86%. Now, typically, I'm a premium seller. So what that means is I normally want to sell premium in a high volatility environment. Therefore, I get paid for taking on somebody else's risk. So I risk some money and I get paid for it. It's kind of like an insurance, insurance of sorts. So I like to trade in a high volatility environment, which we're definitely not in comparatively to the last little while. I've got a couple of people saying hello. Hi, Kevin. Thank you for always joining. Appreciate that. Max, I don't know if I've had you on before, Max Planks. Well, welcome. Thank you so much. And Allegan, hello again, as always. Striker Greens, with tomorrow being such a binary event, would you recommend playing both sides with the purchase of TQQQ and SQQQ? You know what? I have tried those trades before. They have never worked out successfully. So it's just not something that I have had success with trading both sides. I think when we're looking at binary events, I think we should be playing to one side or the other. The market is showing obviously quite bullish strength. If we look, we haven't even gotten into those the daily moves yet, but looking at the QQQ, this is trading view. We've had an absolutely massive move to the upside over the last month. So we've just seen a big push. Now QQQ is quite correlated to SPY. It has about a 90% correlation. So if we look at SPY, we're going to see the same sort of move. Some of the indexes like IWM have moved quite a bit, but they are moving in a slightly different correlation. So, for me, when I'm looking at my portfolio, I typically am holding a combination of all three of those indexes. I've found over time that I get a more consistent return when I play all three. So when we are looking at trades, I might take slightly different setups on the Russell, SPY, and QQQ, but I am usually trading all three at once. Today, I do want to talk about the honey trap. I think it's a pretty awesome trade. We've had massive returns this month with almost no trades kind of going into the actual trap. But the nice thing about it when we've had a big move like this, it's that we can sometimes target for very, very low risk, quite a large return on investment if the market is going to pull back and fall into a range. So I would like to take a look at at IWM today. I'm just going to turn off my face here, and we're going to look at kind of this zone. Let me just put some lines on here. So if I want to make a trade, I might want to look at a potential pullback targeting out into July. Right now, I'm looking at the July 7th date. So I'll mark that on here as well. And oops, that was the wrong thing to do. Didn't mean to do that. Let me remove that and let me do July 7th. We're going to do a vertical line here. So that is going to be my target zone. I am going to look for a trade, a honey trap trade that will potentially make money if IWM, it pulls back down into this range, down below 179 and above 172. So that's going to be a $6 wide range. And I think that that should be a fairly easy setup. I haven't done it yet. I haven't looked at it today. So you and I are going to do this together. Before we get into that, let's just look at the indexes in general and go over that. So looking at the right-hand side, we've got SPY or SPX up about 0.7% today, which is a pretty big move. QQQ up about 6.65%. So there's, you're seeing that 90% correlation. So they move in step most days. MES obviously is the futures version of SPY. Oil today marking at 69.62, up $2.50 a barrel. So MCL or CL, depending on the size of your account and what you're trading. You see CL is down here. IWM 188, that's the one we're going to look at. It's up 1.25%. So the biggest mover of the three big indexes today. So if I click on this, what that's going to do is open up the options chain over here, and we can take a look at the different dates, the different expiration dates. As I said, I'm looking at July 7th. This is just longer than 3 weeks away. So that's kind of a typical time frame for me to try to set up a trap. In this case, I said I wanted to target the 172. This might be a little bit low. So here's that 172 strike I was talking about. You can see the delta. If we look at the delta column, the typical downside is about the 10 delta for a honey trap, which puts it at the 175. That would be this strike right here. In this case, the 172 is kind of where I drew that horizontal line on the chart. That's where I would like to have my short strikes, but I may not be able to get enough premium to make it worthwhile. So I may have to do a traditional setup where we have 175 as the bottom side of the trap. What we do with this is we typically are selling credit spreads, and we're using those credit spreads to pay for a debit spread. So in this case, we're buying the 170, 175. This is $5 wide. This is just kind of where I start with these types of trades. And in this case, we're going to buy 3 of the 170 puts. We're going to sell 3 of the 175 puts. If we look at the profit profile on this, this is a bullish trade. It's got a 94% probability of profit. The max return on this with a single contract, or sorry, with the 3 contracts is going to be about $75 each. So we're looking at $225 max profit on this. The max return here, you can see, is 208. On the chart, it's actually showing only a single contract until I add the debit spread that we're going to buy. Now, in this case, what I wanted to do was, I said 172, 178. That is so out of the range. Right now, the expected range, the 20 delta position, and you can see that highlighted in blue here on IBKR. This whole range is showing a 1 standard deviation move. And that is indicating that we have a 69% probability that it's going to stay in the dark blue range. Typically with honey traps, we're going to be selling the very lowest strike that's still in that 1 standard deviation move, or around 20%. Then we're going to purchase a long position. Now, the idea with this trade is that I don't want to enter it for a net debit. In order for this trade to work, what I want is no upside risk. And you can see that this is not functioning as I would like at this point in time. If I was to enter this today, buying 3 of the 170 puts, selling 3 of the 175 puts, selling 1 180 put, and buying 1 185 put, I would actually have to pay about $40 for this. So it would be entering for a net debit of around $42 plus commissions, which means that if the index IWM stays above 185, all of these options are going to expire worthless. In that case, if they expire worthless, I'm just out of pocket the amount of money that I paid to enter this trade. So in this case, if I was going to submit order here on this, you'll see that I'm going to pay $42 for the actual entry of the positions, plus I'm going to pay about $5 or $6 around about in commissions. So the whole trade is going to cost me about $48 debit to enter. I don't typically want to enter these for a debit. And the reason for that is because the profit probability is very low. I've only got a 29% chance of making money. If the stock goes up, I'm going to be out that 48 bucks. The ETF in this case. If the ETF goes down and trades below 180 and above 175, which it could, then I will make a very decent return. I make $450 on this trade, and you can see my max risk is about $1,000. So I'm making a 40% return on capital if I get that move to the downside. But what I want to have is no upside risk. So there's a few ways to do it. The simplest way is to just kind of move the long put that I'm purchasing to a lower strike. And what this does is it costs money. I was going to pay to, $229 to buy the 185. In this case, I would only be paying $172 to buy the 183. It means that all of a sudden my probability of profit, the probability is now 95%. I am super likely to make money. The problem with this is a little bit of a misnomer, is that it is just a tiny bit of money and we've increased our risk. So we kind of have to find the sweet spot in this case. Right now, this would be settling for a net credit. You can see somewhere around $10. So if I was to put this on, I would get about $14 credit to open this trade. That's the estimated. I would still pay that $6 in fees. So I would be left with $8 deposited to my account. So that would be the total amount of money that I would be collecting today is about $8. And in that case, I'm not making a lot of money. You can still see here that the max loss on this is $1,191. It's not terrible. Where's my calculator? Let's just say that I did that a couple of times this year. Say I did that every 24 days. I made $8 return, and I was able to do that 14 times this year. I would, 8 times 14. If I was able to do that, I'd be a net credit of $112 at the end of the year. Now we divide that by the max loss, which is around $1,200. And if we theoretically put this trade on every single month and it was successful every single time the market just continued to go up, we would be left with a 9.3% annualized return on this amount of money, on this $1,100. So this is a pretty good strategy. I mean, a lot of people complain that they can't make a 9% return. And this trade actually has the potential of making 9%, plus it has the potential of making so much more. The problem, of course, is that there's a potential of 100% loss of this capital as well. If the market was to fall too far, and if it went down below the long puts in this case, so below 170, I would be taking max loss. It would cost me the maximum amount of dollars to get out of this trade, and I would be down $1,194. So the sweet spot really becomes if it falls down into this range. And what I'm trying to do always is calculate out, am I getting enough credit for the risk that I'm taking? Sometimes it can work out very well to just put on a little bit of a tighter trap. I can go down, this is only $2 wide, and my max profit is now completely reduced. I'm making $230, but I'm still only risking $1,270. So I've increased the risk by $100, and now I have potential profit of only about $230, but my credit is much bigger. I'm actually collecting about $37 on this trade. So again, if the market did run up all year, $37 every 24 days, let's just do that math again to see what the annualized return on that would be if the market continued to go up. So find my calculator here. We said $37. Oh, lost my calculator. Give me 1 second there. Don't know where it has gone. It's right in front of me. Okay, so $37 minus the $6 in commissions. So we're making about 31 times that by 14. This would be the annualized return, $434 divided by 1270. If we were to take the same risk all year. So this works out to a 34% annualized return. And this might be the type of trade that I might consider. The other thing we can do when we're tightening this up is actually look at the bottom side. Sometimes there's a sweet spot. If I'm tightening up the top of the trap, it might be prudent for me to tighten up the bottom. In this case, it's only a couple of pennies different for these three. So I take this $220 potential profit and I have reduced the risk on this trade to $980. That is a substantial change. So if we go back to the calculator, now I do the same sort of math. Let's just submit order to get the price here. We're looking at about a $22 total return or total credit collected to open the trade. And so if we did 22 times 14, which is about the average we could get if we did this every 24 days, we get $308 return, and we divide that by $980 in risk. So now we're looking at a 31% return. So that is a fairly big percentage return and substantially reducing the total risk on this trade by tightening up that lower long put just a little bit. So these trades, I am liking these right now in this low volatility market. I think that there's quite a bit of potential still being able to make a very decent return, 31% annually with a 94% probability of profit. And here's that break even. This is the big one. When do we lose money? So let's take a look at that, 174.27. And we're going to go back over to TradingView and we're just going to mark that right on the chart. So 124.27. So that is the break-even line. So it's important to look at not just the deltas, but actually the past price action and see where is this. Well, that line is right at the recent moving average. We definitely have some trading action below that level. So we could move into the max loss zone very, very easily. And remember, max loss is down here at 170. So this is the profit zone. We lose a little bit before we hit max loss, which would be down here. And we'll put a mark there. So the max profit zone on that, we should mark that as well, is going to be between 175, 180. So let's mark that on there. So here's 180. 180, we'll put a line there. So if the market was dropping down here, I would make a nice, very decent $200 return on a $980 investment, $220 potential profit on that trade. If it stays above, then I'm only making $20, which is still a 31% annualized return on capital. Now, the idea with these trades is that they get layered on all the time. So I'm not just going in and saying, oh, I'm going to throw $100,000 at this trade right now. Even though it's a $1,000 trade, I might not take 10 contracts. I might not take 2 contracts. I might just do one of them. So I can enter one at today's valuation. I can enter one every couple of days and layer these on over time so that I create a nice curve. The idea, like the way I treat my account, is I'm always looking at the profit curve of it. I want to be making money with my directional bias, which is still slightly long, even though it's harder and harder to get long at these values. Just looking at any of these charts, I know that people think that the market's going to go up forever, but if anybody's traded for any length of time, they know that pullbacks happen. And although IWM is still down when we scroll back looking at these daily charts, my expectation is not that we're just going to go screaming back up to $240. I think there's going to be some choppiness happening here, which is why I'm liking these trades where we have the potential of making some money if it drops back on a small portion of the account, while my longer term investments are kind of going up over time, as the market tends to do. And remember, the economy right now is not as strong. Like, the stock market is showing way more strength in the price action than I believe there is. I think with inflation levels, I just can't see this market going up to the previous levels that it was at. So let's take a look at some other questions. So Kevin says, hi Kevin, hope you guys are having a good time in Calgary. Hopefully the weather's as nice as it is here in Kelowna. It was like 35 degrees here yesterday, so I was poolside just enjoying the weather. It's been fantastic. Max says thank you, and glad to have you here with me. Mike A tactical question for you. If you feel an underlying has a good chance to stay between two strikes and you wanted to sell premium, would you go with an iron condor or an iron fly? You know, those, I think that there's three different trades that we can consider in those cases with neutral trades. It really depends on the movement of the underlying. So why don't you post the underlying, and then I'll talk about the three different trades that I like that are neutral strategies when the volatility is increased. So for obviously when we're in a very high implied volatility, the iron condors tend to have the best performance. We get a lot of premium, we get some nice wide strikes, and they make money as long as the stock stays in range. Iron flies can work very, very well. It really depends on how long you want to manage them. So an iron fly tends to want to be held a little bit closer to expiration. So if you're in the camp of closing early, then an iron condor typically has a little bit better overall performance than an iron fly, but both of them work extremely well in high IV environment. When the IV is low, I actually look for Batman trades. So yes, it does look like I've been seeing some sun. I'm trying to get out there, and thanks, Jacob. I'm trying to get out and do as much biking, hiking, paddleboarding, and all the other fun stuff that we get to do here in the Okanagan as much as I can. So it is good to be flexible and to be able to get out and enjoy the sunshine when it is here. So thanks for noticing. I don't try to get too much. I do wear a hat and sunscreen because I think it's important. But back to this question from Mike, the Batman trade, which is some sort of ratio spread. So you can do like a 2-to-1 ratio, a 2-to-1 put ratio on the downside, 2-to-1 put ratio on the upside, or you can do like a 1-3-1 or a 1-3-1 call ratio spread, put ratio spread on either side, or we could do like a 1-3-2, a 1-3-2 call spread on those. So I didn't have a specific question. I think that, like, for example, just to give you an example, when I'm looking at SPY and QQQ, because the QQQ and SPY have a high correlation, I tend to trade different trades on the two underlyings at the same time. So I might take a Batman trade on the Qs at the same time that I play an iron condor on SPY. This way I'm spreading out that correlation because I'm trading two different trades. So most of the time it depends on the particular stock and that IV level. Let's just take one. I mean, I've been trading lots of Batmans on UAL. So let's take a look at UAL. It's up at 53 bucks this morning, and the Batmans have been working pretty well in the shorter duration because I've been able to capture the move. And when that move happens, if it goes into the spike of the bat trade, we end up working very well. Not bat trade, Batman. I should be clear about my terminology here. So let's zip over UAL, obviously United Airlines. Let's look at the expected move from this rather high price. You can see recent highs as high as almost $55, and we have had a very, very strong move. We're on day 6 in a row of green candles breaking out the top of the Bollinger Band. So let's go to Options AI. Now this is something that I absolutely love. I've only been using it for about 6 months or so, but what it does is it uses the real-time options chain pricing to give us an idea of where the potential move is. So you can see on July 7th, this is not just a standard deviation code. This is a cone. This is actually looking at the data and it's saying, well, here is the expected move based on options chain pricing, which is pretty awesome. I think it's awesome. The other cool thing about it, talking about whether or not we're going to do a condor or a fly, is that the trades are built in. So if I just click on neutral here and I go to July 7th, it pulls up an iron condor automatically for me based on this expected move. So in this case, it's looking at on the put side where we would be long the 49 put, we'd be short the 50 put, we'd short the 56 call and long the 57 call. We have $61 of risk, $39 max gain, and you can see how wide this profit zone is. Now it's a 66% probability, and this is very, very typical types of trades that are set up and have been proven to work over time. So Options AI is using this data that they have been collecting for years and years, and they're watching traders and how they're trading, and they've set up a platform that works extremely well. Now, I'm an affiliate of theirs, so I do get paid if you sign up, but you also get a discount. So if you're considering signing up for their monthly information, which just gives you the data feed, or if you open an account with them, if you use the word all caps, in all caps, the word drawbridge, you get a discount. So just so you know, and again, I am an affiliate. I do get paid to tell them that, but I am a user of their service, and I do like and recommend it. In this case, so here's the iron condor. We can also look at the iron butterfly, and this gives you an idea of what two different trades. I mean, they both function very well. The max gains on this are 255. It's got a lower probability of profit. So the iron flies have a technically lower probability of profit. And part of this is because the decay happens very, very quickly near the end. In order to make a very decent amount of money, to get anywhere close to this 255, the stock has to be trading exactly where it is when we open. So it has to be a very neutral move. I typically, I don't know a lot of traders that trade iron flies like this on this duration. I think iron flies work best in very, very short durations where there's not a bunch of time. In this case, we've got 24 days for the move to happen. And we could easily, you can see how much it's moved in the last 24 days. That stock could move just that much again. And if it did, you can see we'd be well into the max loss zone over that same time frame. So in most cases, I'm choosing an iron condor over an iron butterfly. Now, one of the things that this particular software doesn't do, Options AI doesn't do, is it doesn't have a Batman built in. So let's jump over to IBKR and I'll show you the setup of the Batman, because I think it's a pretty cool trade. And it's one that I typically use. So we're going to go over to UAL. Oh, did I just do that? Let's get that options chain open again. Strategy builder, and just making this complicated on myself, aren't I? Okay, here we go. Sorry about that. So let's go to UAL. It should be on my list, and it is not. You can just type it into the strategy builder. So United Airlines. And what I'm going to do is I'm going to go out to that same date, July 7th, which is 24 days. And I'm going to see if I can build a profit profile that has some spikes to the side. So typically, again, like most of the trades that I put on, I like to put them on for a credit. So the simplest form of a Batman is selling 2 puts and buying one closer to the money. So if we look at the 49 puts, 16 delta, we're going to sell 2 of those. So we start off there. Now that by itself, this would be an agreement to buy 200 shares, which we don't want in this case. I'm going to take a position that has 100 shares. And then we're going to reduce that even further. So again, I'm looking for the 16 delta move to the outside is where I might consider starting this Batman trade. This is the simplest form. That's an unlimited risk. So if you look, when we have a large move to the outside, there is potential loss to either side. This is a neutral strategy. The break even's $47, $59. So we're looking here and they're corresponding to the chart. Now, if the stock stays in the middle, which is typical of like an iron condor, so if it stayed at 53.14, but all of these options, because they're all out of the money, would expire worthless, and we would end up with the credit that we collected. Now, in this case, it's 47 bucks. It's actually not bad at all, considering it's a 24-day trade, less than a month. That $47 credit to open is about just less than 1% of the cash secured value on this to the downside, which the downside is going to be $47.69. That would be the cost basis that I would be assigned if I had to purchase 100 shares. So the stock's trading at $53. If I had to buy them at 57 or 47, that would be my max risk on the downside, $47.67 or $4,767. Now, if I can get a credit to open this at 47 bucks, and I'm going to pay some commissions around $6, I'm going to get a net credit to open of about $42. And this is why I love the Batman. If it stays in the middle, it's fantastic. If we get a move to the outside, if it drops back down, there's potential of even making more money. Now, these spikes aren't particularly large, but it definitely can function over time. And when we do have a move to one side, it can set up quite nicely. Now, to make this a limited loss strategy, which is similar to the Condor, now on some platforms you can't do this. I know I get a lot of questions about this particular trade because in IBKR I can absolutely sell 6 legs, and there's some brokerages that won't let me trade in this way. What I would do in this case is I would open the put side and the call side separately. So I would enter the first trade as a this is a 1-2-1 butterfly, and then the second trade I would set as a 1-2-1 butterfly on the call side. So I do a put butterfly broken wing and then a call butterfly broken wing for a net credit to open. In this case, it's much smaller, and the premiums are going to be, or the commissions are going to be larger. I'm only collecting about $7, and the commissions are going to be about that same $7. In this case, I'm not collecting any money to open, so I have to get a move into the spike, or at least close to the spike, and be able to close this. And this is where I might start playing with this trade a little bit more. So let's set up. I'm going to start this again. I'm just going to show you the put side. So I'm going to buy. I'm doing the exact same strikes I just had, and we had the 1-2-1, so which is buy 1. Sell 2, buy 1. So if we look at it by itself, this is a net credit to open. There's a profit spike to the downside. You see, we would open this for about $3 credit and pay some commission. So it's just an ever so slight debit on this side. The risk obviously is to the downside. We're risking 1 to make 1, which is a very fantastic setup. So we could potentially lose $100, but we could potentially make up to $100. Now, making exactly $100 is super unrealistic, but making $20 or $30 on this trade might work very well, which is about a 20% return on capital if we were able to close this for a $20 credit to close. As long as there was a very little cost, or preferably a credit to open. Now, with this setup, what I typically do if I'm looking for a trade like this is I add a little bit of downside risk by purchasing 2 of the 47 long puts and then selling 3 of the 49. What we're going to end up with is another unbalanced butterfly, but we get a much larger credit to open. We get about 24 cents to open this trade. You can see the risk profile has changed. We could still only make about $125 max profit, but we're now risking 286. So this is a substantially greater risk for a smaller return, but we definitely have an 88% probability of profit. What we can do is we just tighten this up a little bit. We put these strikes equidistance apart. So now there's only $1 spreads between each of these, the 48, 49, 50. When we look at the profit profile, it's showing it as a loss up here. But in this case, we're actually going to open this for a credit of $8. So imagine that I open this for $8. I pay some commission. The net deposit in my account is $3. This chart is actually lying to me because it's using the asking price of a debit of $4 to open. In this case, I would actually get $3. So if the UAL stays above $50 for the next 24 days, all of these expire worthless and I just get to keep the $3. So this would absolutely be a profitable trade to the upside, even though that it's showing that it's a loss. Showing a profitability of only 9%, probability of profit of 9%. But in reality, this trade has about a 90% probability of profit. And the risk reward is now back to that 50-50 shot. So we have about a $100 potential gain with a $100 potential loss. So a very bullish trade. Then what we can do is do that to the call side. So again, if your brokerage doesn't allow this, this would be the first trade. I would put on the puts and sell this and get my $10, and then I would do the call side separately. But with IBKR, it's why I use this platform. I can absolutely go in here and I can sell 6 legs, and I'm going to do the same thing. So in reverse order, these strikes are all in order, if you notice. So from 48, 49, 50 on the puts, then 57, 58, 59 on the calls, and the furthest out of the money long position has the 2. So in this case, I've got 2 of the 59s, and I'm going to sell 3 of the 58s. this is going to end up with a very, very nice trade. We got about $14 credit to open. So collecting about $4 and a potential of making a very decent return if the stock moves into this range. Now, UAL it has run up recently, could easily trade down below this break even of 48.55 because it has recently. So I have to know how to defend these. The curve, as you can see, functions similarly to an iron condor. So we can see that dotted line gives us the return on capital if the move was to happen today. As we get closer and closer to expiration, that curve is going to change. So today, you see how the curve just changed from July 19th? The interesting thing about Batmans is they don't change all that much until the very last second. So the curve is getting higher and higher and higher. And if we go out to say like June 1st, so this would be 6 days prior, still having a very, very symmetrical profit profile. And with these trades, the one downside of this is that we have to hold these right to expiration to get this max profit. If on July 4th, let's even go to the day before, even July 6th, the day before expiration, if the stock was trading at 49.82 or even right at the top of the spike, if it was trading right at $49, which would be where our max profit would be, this would actually still be showing a negative return the day before. So really what I need is that move on the 7th at the very end of the day to be trading right at the spike. Ideally, what happens is that the stock moves slightly. So we get a creeping move slowly, 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 but it stays above the long puts the whole time. I have found that on the last day, if on this expiration Friday on July 7th, if that stock is moving anywhere close to that long foot, I typically take these trades off for profit. And you'd be surprised how frequently they can actually make money. This is a pretty nice trade. So I'm actually going to submit this order. I'm going to put it into the ledger and we're going to take a look at how that performs on one of the new streams. So in this case, unfortunately with IBKR, the paper trading, the fills are not that great. So I will not be able to fill this for a realistic price. I'm actually going to have to pay a debit, I'm sure, to open this trade, which is not what would actually happen in my account. In this case, even putting in a debit of 2 cents, still not filling. The in-paper trading account, especially with complex options, I have to put in the ask price, which in this case, I paid $7 to open it plus my commissions. It cost me about 14 bucks. In reality, that would not have been the case. I would have collected $14, paid about 15 bucks in commissions. Let's actually just look at what the commissions are. $6.11 is what the theoretical commission was on this particular trade. And you can see how that breaks down. So each contract charges a different amount. So the 157 call cost 80 cents. The 49 put cost $1.36. So there's a variance in here because $1.36 was divided over 3 contracts. So the commissions do change. Again, one of the reasons why I use IBKR, I'm going to lean this way so I can push this button. I don't know why I don't change that graphic. I should change it to the other side. If you are considering a brokerage, then that is a pretty awesome brokerage to use because the fees are extremely, extremely low. I don't know what has happened. I have a different window open right on top of my I don't even know how that got there. Windows everywhere. Okay, let's get into some other questions. Mike, checking in from Massachusetts. Glad to catch the live stream. Thank you for checking out the live stream. And again, thank you for the likes. I see that there's 22 people online, so I really appreciate when you guys leave likes. If you have a specific stock you want me to look at, I will absolutely pull up the chart and do a detailed analysis of what I would be looking at, the trade potential that I would put on. There's so many variations. I mean, it's the cool thing about being a complex options trader is that I can take a variety of different trades on a variety of underlyings based on my assumption. So Striker's asking, with the VIX being so low right now, which means low premium for us theta sellers, would you ever recommend VIX calls or shares of UVXY? I don't make recommendations, obviously. That's the first thing I would say to that comment. I personally have never, I shouldn't say that, I probably have. I've done some options on VIX, but it is not something that I do on a normal basis. They definitely can work as a hedge. So if we were to look at the VIX, and let me just try to pull up an options chain here on the VIX. Can we get the VIX options? Should be able to. See what it pulls up. There's a couple ways to do it. I mean, you can sell premium against the VIX if you want. There's not a lot of value in it, but if you thought the VIX wasn't going to drop any further, you could selling at $8 for selling the 13 put. Really, the question is it worth it? How big is your account and how much is it going to move? Well, let's just take a look at whether or not we were going to buy something like a 30 Delta call. In this case, it would cost us about $100. And if the VIX did spike, then we would get a move to the upside would generate income because we would be long the call. So for $100, if the VIX went to 27, which it could easily go that high, this trade would make about $600. So about 6 times your money. But it has to have that move. In even the 100% move. Sorry, in order to see that, I gotta turn myself off. So there's the 100% move. VIX of 34 would give us about 12 times return on capital. It really depends on what I want to do and how much drag I want to have on my account. So anytime we're looking at an option, just purchasing them outright, the expectancy is that I'm going to lose money. The profit probability is only going to be 26%. So 74% of the time I'm going to lose money. Is it worth it? I think there's better ways to hedge. I hedge with ES futures. I find that to be the easiest way to hedge. And I do that typically by selling puts to enter. So I actually have more hedging on than I've had on it for a long time just because of this market run up. But if you look at ES, on down days, I've been selling puts against it, and when the market moves back up, I've been using the credit collected from selling the puts against ES to. I know why this isn't working. Here's a little tip for IBKR users. So if you look at my monitor, if you look in the top right hand corner, you see this little chain, a red chain right here, and then if we look at these windows. Let me erase that arrow. There's a red chain here and a green chain here. When I click on something in this window, like if I click on ES, it is going to link to the option chain window that I have open that has that red link. Because I'm clicking on a product in this window, it will change the product here. I have 2 options chain windows open. One's green, one's red. So I'm just going to close the green one. And that way, when I click on ES, then it will update this window. So there, if you're new to IBKR, that's kind of how that works. In the event of hedging, I typically open my hedges on down days. So I haven't actually opened any in the last couple of days because there has been no movement to the downside at all. It's been just the market's been screaming upwards. What I would do is I would go way out in time. So I think September 15th would be the next one that I would be trading. I'd be looking somewhere between 90 and 100 days. So there it is right there. We've got the September contract, December contracts. You can sell either of those. What I would be doing is selling some puts on a down day, looking to collect some premium, and then buying back a greater number of puts if the market rallies up. What I end up with is net long positions. And it does take a little while to kind of harvest that action. But in event of a massive drawdown, having hedging strategies like that have very little drag on the account because we're using short puts to pay for the long puts at a later date, that makes it function very well. Shouldn't say later date. It's the same expiration date. So say I sold 3 puts in September, I would then at a later date buy 5 puts with that initial credit and then try to buy back the original short 3 puts. It's kind of the easiest hedging strategy that I've seen that doesn't cost a lot of money to hold, because all hedges have a carrying cost. Theoretically, what I'm doing is I'm using the profits from one trade to pay for the hedge. So you can justify saying, well, I made that money specifically to spend the money. You're still spending the money. They're still independent contracts. Hedging costs money. Doesn't matter what we do. There's drag in our account when we sell or when we purchase premium. Mike says, I haven't mentioned, I should have mentioned that I was referring to zero DTE. Yeah, if you're talking about zero DTE, iron flies for sure. Right now with the VIX being low, I've been doing double calendars, but if you're doing zero DTE on anything, the iron flies are the winners. I'm just trying to think of something that I could do a zero DTE on. I mean, I can't do it on any stocks because it's not Friday. So I would have to do it on something like ES, and we're close to the end of the day, which is, well, SPX is obviously the easiest way to do it because there's tons of contracts. So if we were to look at, let's just do tab view here, and we'll look at today, zero DTE. There's not going to be a huge amount of premium left, but either tight condors or iron flies. And in this case, like the reason I said that as soon as I saw this chart was because I'm just looking and saying, well, how much money can we make over the next hour if we were to do a trade like that, $10 wide condor. So in this case, the credit to open this would be about $400. The max loss on it, obviously about $560, because the maximum amount of money that I would have to pay to get out of this trade is $1,000. So if the market rallied up above 43.70, I'd have to pay $1,000 to close this trade. I'm collecting about 450, so 475 in this case. So if everything expired worthless, if it stayed between 43.55 before the end of the day and so above 43.55 and below 43.60, all of these options would expire worthless, and I would just get to keep this $460. This profit loss chart is not correct. It's one of the things, like if you guys decide to sign up for my Patreon, I know there's already tons of patrons here, but if you're looking at deciding to support the channel and come into the chat room, see my trades live, you get a ton of perks. One of the things you get to do is download the rolling options record keeper. And let me just open up a rolling options record keeper so you can see what that looks like. Pull this up here for a second. So this is what the sheet looks like when you download it. So when you decide to sign up as a patron, this becomes a free download for the options tier members. And it has a bunch of tabs on it. It's got the open options DTE down at the bottom. It's got the A to Z, a trade comparison, a trade custom, and a trade rolling blank. Now, I tend to roll a ton of my trades, so I specifically designed tracking software, this particular sheet, with the rolling assumption that I'm going to be rolling or adjusting this trade in general. It's pretty simple to use. What I do is I just hit duplicate, so I make a copy of this particular trade. If I was doing that trade right now, the .inx SPX trade, this uses Google Finance to pull the data, and I can type in whatever note I want here. So in this case, I would say like zero DTE trade. And what that will do is it will pull the price. It tells me the current price is 43.59, and today's date is going to be June 13th. Underlying price at the current price, we're just going to input that from our IBKR screenshot here. So 43.58, and I'm going to assume that I'm going to collect about $430 for this trade to do the 43.45, 43.55, 43.60,
4370 Condor. So I'm going to input this right now saying $4.30 credit to open this trade. And then we'll see a proper profit loss chart, because IBKR does a terrible job on 0 DTE. Shows a probability of profit 49%, which is exactly what we expect from a tight condor. In this case, this is a 50-50 shot, but we're also, risking one to make one. And you can see the value is dropping here, and will continue to drop if the stock stays, or the SPX stays in between these two strikes over the next hour before the market close. So let's just jump back over to this. We're going to say 43.58. You can put in the decimals if you want. This is a fairly fast moving trade. We're going to do this as a condor. So as soon as I type in condor, what it does is it's showing us red and saying you're missing some information. The sheet is designed to force you to fill out everything correctly. So the first thing we're going to do is the options expiration date, which is going to be today. I just use the hotkey, my keyboard command : will just enter the date in Google Sheets. So there's a little tip for you. That long strike that we're looking at is going to be the 43.45. We are going to be short the 43.55. Then we're going to be short the call, the 43.60, and we're going to be long the 43.70. So very, very simple. I mean, this is designed for traders, and I've got it set up so the long puts are typically low, the short puts are kind of in the middle, and it just highlights exactly what we're supposed to be entering to make this trade work. Now, the transaction credit in this case, I said $4.30. We're going to do one of those. And then the margin requirement, you can just, on a condor, you can just look down. All you have to do is just scroll down. You can see that if we got $4.30, the max loss in this is going to be $570. So as soon as we type in here, 570, it will, and then we type in US dollars, it will give us the potential, the projected return. So making a 75% return on capital if the market stays where it is, because we'd be basically making $430 at a risk of $570. So this profit loss chart is way more accurate than IBKR's. It doesn't include commissions, but the profit loss summary does. It shows the estimated fees to date of $260. Let's go back to IBKR and just open this trade and see how it goes. So in this case, you can see that the credit's already dropping, and this is why these trades make money. Stock is still in the range. Oh, it's moved out of the range, 43.62. So, and again, what we don't want is a move to the outside. In this case, this is where I might decide to move up. I have waited, I've been watching the market, and I'm saying, well, maybe I don't want to take that particular trade. Maybe I want to adjust this. I now think, since it's trading at 43.62, up 0.5%, that it's going to continue to climb higher into the close today for the next hour. So in this case, this trade is going to get about $420. I'm just going to jump over to my platform, and I'm going to change all these strikes. So 43.50, 43.60, 43.65, and then 43.75. Again, smaller credit. We're looking at only a $4 credit to open, and we're now changing because the opening price is different too, 43.62. So again, this is why flies make a lot of money. And there is, in the last hour of the day, this type of trade can make a massive return. I mean, there's not a lot of investments that if the SPX stays in this range, it's cash settled, so it's very easy to manage. You just put it on and it settles out at the end of the day in the next hour. And can you make $400? Yes, but can you lose $600? Yes. This is why you get high reward for that high risk trade. But I use this software, this Google Sheets, to input this data and help me visually look at what is actually happening. And I have a bunch of notes in here. It shows different notes on entry. I don't know, like once this completed, it showed that the red went away. As soon as you delete any portion, it's giving this little warning that something's not complete. So we're looking for this box red to go away. And you can put in incorrect data. It doesn't stop you from putting in incorrect data. Like in this case, putting in a negative $4 will just show that you have a 0% chance of making money. So you have to still enter the information correctly to get the correct return, but it does help you along with some of the data entry in these cases. So that's a little glimpse at the rolling options record keeper. I've been using it now full time for 3 years. It tracks everything. So if I refresh this, it'll just show you that position. Automatically, it tells me when I made the transaction and the option expiration date. So I can look at all of my positions real time in the A to Z chart. And then to add them into here, it has this little note. It says missing INX 0 DTE. The reason that I have this as a manual entry is because of this column right here, this current option price. So what I can do is I can say, I can do an insert. Command K is how you insert, and you can just choose from the list or type it in. And now that gives you a direct link. So I can jump back and forth between the order sheet. Why did that? I did that wrong. Sorry, I entered the wrong sheet. Look at me, I'm talking too much. Command K, we're gonna do the .inx. So type in .inx, we're going to choose the sheet that I want to have. Then it's going to pull up the information and give me a link. So I can jump back right over to this detail page, or I can jump back to the summary sheet. So that's one of the reasons why I have that input. But the other reason is because I can say, well, what happens if I take profit on this? I collected a credit on this case of $4. What if I decided to fill this for a debit of $2? I can see that I would make on a single contract, the realized return would be 377. Sorry, 20 cents. It should be 20. It should be minus $2, not 20 cents. $2. You can see that the profit on this, I make $197. If I collected a credit of $4 to open, closed for a debit of $2, and that is factoring in some of those commissions. So you can see that the debit to close would be $200 and minus some commissions. So it factors all of that portion in, and you can adjust it on the detail sheet to make it accurate. Otherwise, it's just an estimate, which I'm fine with. I don't use this particular sheet to actually report taxes with. I use my brokerage platform. I use IBKR's reports to report taxes. This is just a way of me looking at all of my open positions, and I can just scroll through and see that. And my patrons know, because we do that review on Thursday, so I can go through all my positions and they can look at that sheet anytime. Right now I've got 130 something active trades on, and you can go, as a patron, you can go into the Google Sheets and you can look real time as I update it as I'm making the trade. So it's a pretty cool thing that I've developed. And I mean, I do it as a training tool. I do it so that people can talk to me and ask really specific questions, because I think that options trading in general is so nuanced. There's no 100% right way to do it. There's no perfect trade. There never has been. What we're trying to do is put ourselves kind of in front of the train, so to speak. We're like, let's put ourselves in a position where we're going to get hit by a massive amount of money coming at us, and say, let's grab this if the market moves in the direction that we think. Options allow us that ability to do that, where we want to be able to make money based on our assumption of that move. To Manila Madness, the Theta Fairy you put on last night, what was your thought process? The nearer expiration would decay faster than tomorrow. That's correct. So it's not actually a Theta Fairy that I put on, but thank you for asking. So the Theta Fairy is a trade. It is an overnight strangle. I've been doing it quite a lot this year. The VIX was high enough that we were getting paid for that. So very, very simple trade. I am selling it out of the money put. I am selling it out of the money call. I'm doing that around market close with the expectation that I'm going to take only about $2 profit overnight. So with the Theta Fairy, I am selling a strangle. So I'm selling it out of the money put, selling it out of the money call on ES, and I'm collecting around $7 in credit. I then put in a good to cancel order to buy back that for a debit of $5. Just trying to make that $2 in credit, and the ES is a 50 points. So I don't even know how to say that. $50. The ratio is 50-1. So for a $2 move, I make $100 profit. That's the Theta Fairy. Right now, let's look at it right now. The premiums are terrible. You're just picking up something that is way too tight. So let me jump over here to ES. The market's still open, which it's fine. You can put this trade on any time. I mean, the ES trades almost all hours of the day. So the idea is that today is June 13th, and we are going to go to the weekly that expires tomorrow. So typically I would be looking at the 43.15 and then selling the 44.15. Oh yeah. I was going to say, there's no premium in this. That's $100 wide. So this is because of what's going on tomorrow. We've got the FOMC announcement tomorrow. So there's quite a bit of premium for the expiration tomorrow, which means this is typically not going to be a great day for the theta ferry in general, because we've got this binary event happening tomorrow. The decay overnight is not going to be there. The idea with this is that we would be getting $7 credit. We would be closing it for $5. We try to do this overnight, or at least before the market open. When there's binary events, and this is why you kind of have to pay attention to the market and know what's going on. I mean, you can tell just by the fact that this is a 100-point wide strangle. Lately, these strangles to try to collect $7 have been like 25 points wide or 30 points wide. It's been ridiculous. So normally over the last 2 or 3 weeks, 2 weeks maybe, about this wide. So in this case, I would be collecting $22 credit, and that is about the tightness of the strangle that we're seeing as of late to get $7 credit. So tomorrow is an anomaly because of the announcement. If we're looking at the what I did yesterday, I basically am selling this position, and then what I would be doing, and I definitely would not do this trade today, but I've been doing a calendar spread. So I've been purchasing a long option at the same strike. So I have 2 puts, both at the 43.50, one with 1 day to expiration that is short, one with 2 days to expiration that is long, and then we do the same thing with the call. We would buy a 43.85 call. What this does is it changes it. We now pay a debit to enter, or this costs us money. The max return is around $580. This profit chart is all wonkadoodle. It just doesn't look like this. I mean, the theoretical portion of this is if we have a massive sell-off to the downside tomorrow, we're going to have a ton of extra premium in the long put that still has 1 day to expiration. All the extrinsic value of this June 14th will be gone tomorrow. So there is potential to make money off this trade, but there's a risk that the market moves a ton. We end up having to pay some of that extrinsic value, and we could lose whatever we pay to enter this. In this case, paying about $750 credit, which works at about $375 max profit to the downside. And I don't even know why this would show this crazy return. Like this trade cannot lose this much money. I mean, you have a long call in place. So the debit paid is the max loss on this particular trade. And there's $375 risk to make a substantial amount of money, because once these short options have no money left in them, then whatever value is still left in the long positions can make money. This is the trade setup that I did last night. Again, specific, it's a day-by-day trade, so not taking this trade today. That it's just not the right setup, which is where like the nuanced trading comes in. Once you're familiar with it, you should be able to see that. Like as soon as I pull up the chart, I know that there's an announcement going on, because that's a trade that I do all the time. So what we do over time is we try to overly simplify everything. So we're putting on a trade that is, how much are we getting for this Q's honey trap? Are we getting 30 cents, 40 cents on a regular basis? And we just keep layering them on, doing it over and over and over until we get into a position where our account is just building and we've learned that knowledge. So in this market right now with low VIX, I think trades to try to focus on things like the humpback, Marauder, Viking trade is working all right. So these are fun. You probably never even heard half of these, because some of these trades get invented in my chat room and we trade them.
Again, patrons, if you sign up to be a patron, you get to get a digital download that has a Google Sheets that has a breakdown of every single trade that I trade and the style and the optimal position entry, what I'm looking for profits. It's a ridiculous chart, and that's only available to patrons. So if you're not a patron and you're thinking, wow, I love your rolling options record keeper, I'm thinking about buying that, I want to be in the chat room for a month, for $50 US to sign up, you get to hang out with me, and we are putting on some trades. The results have been amazing. So Theta Fairy, not happening right now. I haven't done it in over a week. I am doing double calendars, and we'll continue to do so. Mike says, thank you. I appreciate that, Mike. Thank you. And you guys are great. Thank you so much for putting on all these likes. That is fantastic. Foyed saying, hey, glad to catch the stream after yoga. How do you trade SPLG? It is only simple trades. I was trying some butterflies, but the spreads eat most of the premium. The problem with SPLG is that the spreads are too wide. So there's some indexes, like I love SPLG specifically because the size is so small. It replicates SPY, but instead of being like SPY right now is $436. So in order for me to sell a single covered call contract, that's a $43,639 investment if I was going to buy 100 shares today to sell covered calls against. Well, with SPLG, it's just a smaller product, and it functions exactly the same. The expense ratio is actually less. The problem with it is that it doesn't have as many liquid options. So it has plenty. I'm definitely not worried about liquidity, but the spreads are slightly wider. So as soon as we get into this low volume, low option interest, we're looking over here with these numbers being too tiny relative to SPY. Like if we look at SPY on that same date, you'll see how much volume there is. It is looking at the July 21st, you see every strike has thousands of contracts. Boy, there's a lot at 40.25, or 425. We got 28,000 contracts, 21,000 contracts at the 430. Not a lot of puts trading up here, but we'll have a decent amount of calls on that side. So 445. And this is where that options AI that I showed you before, they're using this chain to pull that data to get a more exact price than just the standard deviation. Standard deviation cone is just a mathematical formula. So IBKR is when you're looking at this dark blue range from 421 to 452. This is just the cone that is generated right here. We're looking at SPY. So that is this dark blue cone, which can be moved over this little arrow at the bottom. If you pull this over, you can turn it on. I do have a short video on my YouTube. If you look at the shorts, one of them will show you how to turn on the standard deviation code if you're unaware. So you can watch that after. But in this case, the options AI uses a different algorithm than IBKR, which is why I like options AI. So I'm typically using options AI to look at that theoretical move. What else can I say about that? So yeah, in SPLG, which is what we were talking about, there's just not enough liquidity. There's not enough options being traded. So in that case, all I do is buy stock and sell covered calls. And the price point means that for $50,000, I can have I can have almost 10 different strikes. So I can spread my strikes out a little bit, which gives me a little bit of safety, a little bit of buffer in my account. It gives me some flexibility when I'm purchasing these shares. With SPY, a lot of traders that are starting out, they don't have $43,000 to just put into one underlying. I mean, it's a very good long-term passive investment to do that. But even buying one share at a time, $436, to get from 100 shares to 200 shares is substantially difficult. You're doubling your account. Whereas if I had 800 shares of SPLG for that same price, well, if I'm making 1% a month off of that, I can actually buy 8 shares a month. After how many months does that take? Buying 8 shares a month. What's the math on that? It's about just about 12 months. So from now, if I had 800 shares, a year from now, if I purchased 8 shares every month, I would have almost 900. I've increased the amount of covered call writing that I could do from
8 contracts on 800 shares to 9 contracts. And then that compounding starts to happen faster. So that's why I trade SPLG specifically. So I get the multiple strike selection, smaller product, and I can kind of dollar cost average in a little bit easier for the exact same trade essentially as a SPY with actually smaller expense ratio, which is crazy. So for long stock holding, there's no question in my mind, SPLG over SPY. Jacob, have a great day. Love your light attitude. Every week, get a Wonka doodle. I'm glad. That is awesome. You guys are great. Thanks, Jacob, for joining. Can you comment on NVIDIA credit spread? Is it good, bad? I'm looking at the 721, 475, 470. The calls, I'm assuming. NVIDIA's trading at 408. So let's look at options AI. That'll give us the expected move. Pull up options AI here. I just don't even know what I did before I had this. Can't speak highly enough of the data that I get from here. So July, we're looking at July 21st. July 21st, 47.75. The expected move right now is 9%. So 446 to 371. So yeah, I mean, it's going to be a high probability trade. The expected move right now is only 446. So selling the 475, 470 is going to be a great little trade. If we just go on here, let's look at what options AI is looking at. They're looking at the, that's like a full bearish trade. Out of the money credit spread. Here we go. 460, 465, 74% probability of profit. So I think you're probably not getting enough credit for risk received in that case. When we take trades that are higher probability, that don't have the potential of making money, we often are taking a substantial amount of risk. With credit spreads, I like to try to use my money as to the best that I can. I just want to make sure that this is the right date. That is incorrect date. We're talking about the July 21st, right? So, yeah, I mean, this has still got an 80% probability of profit, $77, risking 43.23. NVIDIA could easily continue to move up, but it has had a substantial move. So let's look at how much credit we're getting for that trade. I tend to be pretty aggressive with my trades, so I like to collect enough credit to make it worthwhile. But if we go out to July, let's look at the 470, 475. So yeah, there's tons of volume. You know, looking at this, like on NVIDIA, look at how much volume there is. Yeah, there's nothing wrong with this premium. There's nothing wrong with it. It's a huge, if you look at the profit profile, and getting paid $60, 84% probability of profit. Is there something better? I'm just looking here to see what else could be done. If you want to hold to expiration, this trade collects $48, has the potential of making 500. Break even's 475. So the trade that you suggested actually has max loss at 475. This one has its break even at 475. Could make $500. I would only take a trade like this if my expectation was to hold to expiration. So it depends on the type of trader that you are. Some cases, what I do, depending on sizing, is I might take one of each. I might say, okay, well, I'm going to take the this butterfly, the 1-2 butterfly, and then I might also take that of 447 or the credit call spread, the 470, 475. This is what creates a 1-3-2 butterfly. So if you look, just follow me for a second. What if I was to slide this up to 475 and I took this trade, which is a butterfly, which is where all the money's being made. You know, you're risking $10 to potentially make up to 500. So pretty awesome little trade. if it falls into this range right at 470, then what I would do is I would add the credit call spread on top of this. So I would sell one more of the 470s and I would buy one more of the 475. So let's just do that. I would change the selling from 2 470s to 3. Then I would purchase 2 of the 475s from 1 to 2. So I've combined a butterfly with a call credit spread. Well, now I get this credit open of 55 cents. I have still the same amount of risk. My break even is way lower for 472. I now have the potential of making $500. It's pretty awesome potential. Of course, this has to be held to expiration. So, these deltas, looking at the delta column, I mean, there's a 19% chance that it could trade above 470. So there's very easily could trade above this, and holding the expiration means I'm in this trade for 38 days. The credit spread by itself can be closed much earlier if the stock moves down or sideways. We'll be able to be closed for a much smaller amount of money much sooner. So these don't have the decay of a call credit spread, but they have a massive potential. So it really depends on trader assumption. That's how looking at these trades saying, well, what if I combine a butterfly with a call credit spread? And then depending on contracts, this is where you just bump it up. If you're doing, if you're a 2 contract trader, well, having that butterfly in there is awesome. It's an awesome little bonus. So that is something to consider, like adding butterflies with the credit collected on when you're trading a bunch of extra trades, because it gives you this little chance, a little lotto ticket play, so to speak. Mike says we need Levi to make a Wonkadoodle t-shirt. Yeah, absolutely. You guys want me to do some t-shirts? I would love some t-shirt ideas. That would be fun. I wear like a Levi's t-shirt. It's kind of funny because I can just go to a store and I can buy branded material for myself, which is pretty fun. My whole life has been like that. There's no question as to what kind of jeans I'm wearing ever. But should we do that? Should we do some Let's Get Rich Together t-shirts? I've tossed that idea around a bunch of times and said, like, what if we had shirts that were branded? That's my favorite saying. I think everybody loves that. That's what I want to do. I want everybody to be rich. Wouldn't that be great? So Wonkadoodle. Yeah, I'm noting that down. I'm going to do it. Yeah, it's going to happen. Okay, Zed Estate BC, welcome. I haven't seen you in a while, Zed Estate, but thank you for joining as per usual. I have 500 shares of game and would like to do a covered call. How could you suggest a covered call options to sell? Again, no suggestions on this channel, but I will definitely look at what I would do. I'm glad that you didn't tell me what the cost basis was, because one of the things that I never do, I try not to do, I can't say never, but I never try to think about my cost basis when I'm selling calls. The reality of this in GameStop, I mean, I don't know what the cost basis was, but if we look back, sorry about that. I pushed the wrong button. What am I trying to do? I'm trying to push this button for a second. Just have to move this guy out of the way. What we're doing is, let's look at GameStop. Let's just look at this move. I don't typically trade GameStop, so I hope you're up money. Like, I really hope that we're talking about something that is, these are 1-day indicators that you didn't purchase for $500 or something crazy. Wow, look at that Bollinger Band. That's crazy last year. So stock was trading $1. What was the high? 111. So I'm really hoping that when you say you're looking at selling covered calls, that you weren't in this for a huge amount of money, because in the last couple of months even it's dropped in half. GameStop obviously short squeezed last year. This is one of the big pandemic stocks. There should be, in theory, there should be covered call premium on this particular share. So there's a couple of different setups that I might consider that should work. So let me take a look, and excuse me if it takes me a minute because I don't typically play this. So first of all, with covered calls is there's no risk to the upside. So when we have long stock positions, all the risk is to the downside. It's like I have 500 shares of stock. What is going to happen if they go down? I'm going to lose money. What if it goes up? I'm going to have more money from the current value. Typical is selling 30 delta calls. So when I look at a position on a normal stock, I want to make about 1% per month selling the 30 delta calls. So we look at this column right here, and we look down at the 30 delta, which in this case is 29.50, and we look for this premium, and we do a quick math in our head. We say the stock's trading at 27.40. Can I make at least 27 cents selling this? Well, in this case, selling that 30 delta actually gives me 55 cents. It's a huge amount of money relative. That's almost 2%. This is in 3 days. So there must be some sort of announcement happening. Is there earnings coming up? Earnings already passed. So they surprised by 1 cent. By 1 cent. And they missed. They surprised by a negative 105 million. Okay. And then on that news, stock dropped, came back up. So that's kind of what has happened. Again, I don't really follow this, but I would be looking at that 29.50 and saying, am I getting enough money? In this case, getting 2% on 3 days is pretty amazing. But it also leads me to think that there is a lot of upside potential on game after that announcement. So what I can do is I can actually look a little bit further and say, this is a stock recovery strategy that we can employ. If I think that the stock may go up, what I can do is I can use some of this credit to actually put in a call ratio spread. So say I buy the 29.50 and I sell 2 of the 30.50s. What that will do is I actually get a credit to open it. So I get paid 30 cents today, 33 cents. And then if the stock goes up above 30.50, I actually have a $1 embedded call spread in here. So I'd actually get paid another $1 to take this out. I actually did this similar trade on UAL looking for the up move after a strong down move. I was able to close today for an extra credit by putting on this type of trade. So I don't get as much credit as just selling the 30.50 call, but I have the ability to collect a credit and potentially more if the stock moves up. And if it doesn't, I've still made 1% this week. I've actually reduced my cost basis by 1%. In this type of position, especially with 500 shares, what I might do is I might not cover all of my shares. I might put in a position where I am just covering some of them. Or I might do a butterfly to the top side is another way to do it. So you can do all sorts of things when you have long stock positions, because at some point in time, you've got this risk. Let me just add a stock leg to this. And you'll see what happens when we do that. There's now no longer any upside risk. We still have this potential of making money on a small move. If the stock was to move up to 30.50, we have the ability to make more than we would if we were just holding stock. But if the move is stronger than that, we're capping our upside. So I tend to play covered calls on the very, very short duration. And when I'm starting, depending on my assumption, looking at these option prices, I would be looking at above, and I would probably be looking at some sort of setup like this, going a little bit complex, doing a 1-3-1, knowing that if the stock can move up, I could get a nice $100. I can use that. If it's gone up substantially, I can use that $100 to roll to a higher strike if I want. It increases my probability of profit. You can see that right here, 54% probability of profit. Of course, holding stock is 50% probability of profit. It's 50% chance it's going to go up, 50% chance that it's going to go down. So, my cost basis is on 19. Oh, so you've done really well. So you're doing awesome anyways. Active investor, Cowen purchased 10 million in shares. Holy, that's a big purchase. You're saying you're gonna say that I'm gonna get off this and I'm gonna go in and do some sort of bullish strategy on on GameStop. I might do that just because it's fun. There's a lot of potential upside in that just looking at those moves. Elegance, how many hours a day do you trade and what kind of return might you get per year? 10 to 20% more or less. Yes, the last year was a little bit less than I would like in 2022 in my margin account. My RSPs, I actually was flat on the year in 2022 and my TFSA. So those returns were great. I actually had no drawdown over 2022. My RSP is only up about 5.5% year to date. My TFSA is up like 22% year to date. It's doing pretty well. Those are both just the covered call strategies. So long stock, reinvesting, selling premium, usually at the money or in the money. I tend to not cycle out of those too much. I just am pretty aggressive about what holdings I'm holding. And I do have a large holding of QQQ, which is why I had the returns in my TFSA as of this year. But typically, I think 10% is a little bit on the low side. If you look at like the average returns over the last, I've been option trading now for 9 years. I think I'm around, it's somewhere between like 16 and 18. I actually haven't looked at it. Yeah, and last year's drawdown was a little bit sucky. It did pull down that average a little bit, but I think a good target for people to look at is somewhere between 50 and 30%. I mean, you can definitely, if you're selling short puts, you can make above 30%. But as soon as you add upside risk, there is risk that when the market moves up too strongly, like today I closed 2 SPY condors. The SPYs just moved up too much. Both those were closed for a loss. So my SPY exposure, my SPLG exposure is making money, but those condors kind of clipped back some of that profit. So my optimal target zone is around 15 to 30%, and over the last 8 or 9 years, I think this is year 9. I am on the lower side of that range. So my average is below 20%, but above 15. Making 10%, I mean, the market makes 9.8%. So very easy strategy to just add like a sell an at the money covered call on long stocks. I mean, your 10% is like, that's the easiest strategy in the world. You can do that 12 trades a year on one underlying. I have one account that's all I do. I just have shares of SPLG and I just sell covered calls, and that's it. I'm actually doing it as a tool to try to teach people how to do that. And I'm trying to track that specific account just to be able to show how steady the growth is. And in that, there's very little time spent, to make 12 trades a year, for me, and we're talking about 2 hours total over the whole year when I'm thinking about that account. I mean, if I was really stretching it, I might say, well, I spent 5 hours, and that would be going over all of my reports every month and saying, oh, I'm going to spend 20 minutes looking at the statement, which I don't do. How many hours a day do I trade? I actually trade, it varies. I think on the week, I probably actively trade between 5 and 10 hours a week. The main portion of what I do in a day is actually dedicated to supporting people like yourselves. I mean, I respond to emails more hours per day than I would like to admit. I wish it was less, but I get a lot of requests for things and I don't have an assistant. I just respond to emails. So if you send me an email and it takes you a little while, it takes me a little while to respond. It's only because I'm like responding to other people. I get a ton of questions. I'm in my Discord chat for a couple of hours every single day, answering questions, posting, trying to like inform people about what I'm actually doing. And I'm there, my trades, I post them so that people can ask questions. That's the whole idea behind it. So I spend a lot of time doing that kind of stuff. But I like it. I enjoy what I'm doing. But for actual trading, it's not all that much. I mean, otherwise I wouldn't be able to do this type of stream. I wouldn't be able to sit here and just do this with you guys. So, and it gets, the more complicated you get, the more you have to look at it. But a lot of times, I mean, I can do if I have less than 50 trades on, I can do my whole review in about 15 minutes in the morning. It's pretty simple to go through. When you get over 100 trades on at a time, it takes me a little bit longer because there's some nuances in some of those trades, and some of the tickers I have multiple trades on. So I have to kind of think about how they work together a little bit. But yeah. That's about it. Okay, we're at 12:30. You guys have been fantastic. I'm going to push this button because that is what I want us to do, is get rich together. You guys are fantastic as always. I will see my patrons on Thursday. I'm going to see everybody else next Tuesday. Thanks again for the likes. Appreciate it very much, and I will see you very soon. Thanks so much. Let's get rich together. Take care. Bye.